Hi everyone, welcome to Investing in 2013 and welcome to this week's Montgomery Video Insight. I'm Russell Muldoon, a portfolio manager with Montgomery Investment Management, and this week I'd like to talk to you about some recent conversations I've had with investors since the start of the year about investing in the market. In particular, the emphasis on trying to time their investing into the market both based on the concerns around global macroeconomic risks. Now, a number of investors, despite the recent share market rise, have said to me they're not willing to commit funds to investing in stocks or the market at the moment, given their concerns about the recent political impasse in the recent US government budget talks. They're concerned about the upcoming debt renegotiation talks. They're concerned about 2013 being speculated by Russia as being an all-out currency war. They're concerned about the Bundesbank Bank repatriating gold from the US Federal Reserve and what this will mean for central banks. And they're even concerned about the recent change in politics over in China, what that will mean for Australia. There's clearly nothing to be, no shortage of things to be concerned about when you're looking at global economic risks and macro issues. But invariably what we find is over time, because there's no shortage of these major headline-grabbing events are a distraction from what investors should be doing. If you have $25,000 or even $1 million to invest in the market, trying to time your entry based on your view of the magnitude and the timing of these events is almost an impossible task. Just think about the logic of it for a second. There's 200 companies in the ASX 200. There's 500 in the ordinaries, and there's almost 2,000 in the entire Australian Stock Exchange. Trying to predict the impact on every single one of those businesses of any of these macroeconomic events is almost an impossible task, and it's just something that no one should ever try to undertake because the chances of doing so are virtually nil. So what we do at Montgomery and what we would like you to do in 2013 is refocus your energy and your efforts onto really simplifying your investment strategy. And what I mean by that is really just dumbing down everything you do, turn off all those news headlines and simply focus on the business. Focus on the business, its revenue drivers, its profit drivers, its business strategy. And if you do that and you build a portfolio of wonderful businesses with wonderful outlooks, you can't help but outperform the market over the long term, irrespective of when you bought them. So it's unlikely that the Reject Shop, for example, opening 40 new stores this year at a cost of $400,000 a store with a payback of 12 to 18 months, it's unlikely that they're going to stop reinvesting their cash flows and hence improving their earnings growth profile for the next 2 to 3 years on some latest news headline. It's unlikely that Credit Corp, who just recently announced an upgrade to their purchases in 2013, how that won't see earnings increases in 2014 and 2015, irrespective of what happens in the global marketplace. It's unlikely for Seek, for example, that the business will stop investing heavily in its overseas business units. Australia only accounts for 2% of world GDP, so its online classified business can be significantly larger. It's now investing in 18% of the world's GDP through Jobs DDB and Zerfin and the like. So we see 5 to 10 years growth for that business, irrespective of what we see in the news. They're the issues that we focus on. We focus on good quality businesses that have very, very good growth prospects, irrespective of what's happening. We fill our portfolio with those companies, and we think you should do the same thing. So make 2013 the year where you stop focusing on all the market noise, focus on businesses instead, really dumb down your investment approach. And we look forward to hearing some great results about your portfolio, how it's built with wonderful companies, and how it's doing significantly better than the index. That's all for me today. Please continue to follow Roger on Facebook and Twitter, and we look forward to seeing you soon.